You've probably heard of Forex trading, right? And maybe you pictured something super complicated, something just for Wall Street pros. Well, forget all that. In the next 5 minutes, we're going to break it all down and give you a super clear roadmap to get started. Let's just dive right in.
First off, let's just get a sense of the scale here. The Forex market isn't just big, it's the biggest financial market on the planet. It's this global giant that literally never sleeps, running 24 hours a day, 5 days a week. We're talking about a daily trading volume of over $6 trillion. Yeah, you heard that right. That makes the New York Stock Exchange look tiny in comparison. Okay, so hearing about trillions of dollars can sound a little intimidating, can it? But here's the thing. Behind all that complexity, the main idea is actually really simple. So what are you actually doing when you're trading Forex? Let's get into it.
So let's answer that question. Forget all the crazy charts and squiggly lines for just a second. At its heart, Forex, which just stands for foreign exchange, is simply the act of trading one country's currency for another. That's it.
Every single trade is built on something called a currency pair. So think of Euro USD. When you trade this, you're basically making a bet on which of those two economies is stronger. If you buy the pair, you're saying, I think the euro is going to get stronger compared to the US dollar. If you sell it, you're betting it's going to get weaker. That's the game.
All right, so you get the big picture. Now, let's get you up to speed on the lingo so you can speak the language of the market. Knowing these terms is absolutely key, so think of this as your quick and dirty vocabulary lesson.
First up is the pip. It's just the tiniest little price move a currency pair can make. It's how traders measure everything, how they count their profits and their losses. It's the basic unit of measurement.
Next is leverage, and you got to pay attention to this one, because it's a real double-edged sword. It's basically like a loan from your broker that lets you control a much bigger position than your own money would allow. Now, this can magnify your wins, which is awesome, but, and this is a big but, it can magnify your losses just as fast. It's a power tool, and you have to treat it with respect.
So you might be wondering, how do the brokers even make money? Well, that's the spread. It's just that tiny little difference between the buying price and the selling price. The easiest way to think about it, it's the entry fee you pay to get into a trade.
Okay, now for a term that every single trader has to live and breathe by, the stop loss. This is your safety net. It's an order you set that automatically gets you out of a trade if it starts going badly. This is what protects you from those huge account-wiping losses. It's not optional, it's essential. And on the flip side, you got the take profit. This is your happy exit plan. It's an automatic order that closes your trade when it hits a certain profit target. This makes sure you actually lock in your winnings before the market decides to turn around on you. Okay, you know what it is, you know the lingo. Now let's talk about how to do it. We're moving from theory to a practical, step-by-step plan that's all about helping you start out as safely as possible. Let's walk through this. First, choosing a regulated broker is your first big safety check. Then, and listen up, because this is the most important step of all, open a demo account. Think of it as your own personal trading flight simulator. You get to practice with fake money, but in the real, live market. From there, you download a platform like MT4 or 5, you learn the very basics of how to read charts, and you practice using that stop loss and take profit we just talked about. Start with just one currency pair to keep it simple, and only after you've looked at your demo results should you even think about trading with real money. Now, knowing the steps is one thing, but avoiding all the classic rookie mistakes, that's a whole other ballgame. To really get ahead, you have to understand the huge difference between how a beginner thinks and how a pro thinks. And the real secret isn't some magic indicator or complicated strategy. It's all about the mindset. Look at this comparison, because this is everything. Rookies almost always fall into these traps. They get emotional and start revenge trading after a loss. They abuse leverage and risk way too much. But the pro? Their mindset is built on discipline. They risk a tiny set amount on any single trade, like 1 or 2% of their capital. They know simple works, and they have the patience to wait for the right trade to come to them. And most importantly, they know that taking small losses is just a normal part of doing business. It's not a personal failure. So as we wrap this up, let's lock in 4 final rules to live by. Number 1, start slow. This is a marathon, not a sprint. Number 2, stay consistent with your learning, with your strategy. 3, keep a trading journal. You have to learn from what went right and what went wrong. And finally, never ever forget this. Your number 1 job as a trader isn't to make money, it's to protect the money you already have. And that really brings us to the final thought. You've got the knowledge now.
You have the roadmap. The path is clear. But the biggest factor in whether you succeed or fail isn't the market, it's you. So the only real question left is your discipline ready for the journey?